Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, June 11th. Encouraging trade headlines for US and China maintain market mood in a sweet spot, but bulls wait for more details to break above critical levels. Now, investors' attention will be shifting toward the US inflation data and UK Chancellor Rachel Reeves' spending details today. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So, trade headlines are optimistic this week. US and Chinese officials apparently agreed to plan to ease trade tensions, which could then revive the flow of sensitive goods between the world's two largest economies, according to the latest Bloomberg news, while the US and Mexico are also about to close a deal that would remove the 50% tariffs on steel imports. So mood across the Asian markets is pretty risk on this morning. The Chinese CSI 300 index is up by 0.82% at the time of talking here. The Hang Seng index in Hong Kong is up by 0.95%. US equities were upbeat at yesterday's trading session, with big technology leading gains on hope that the US-China deal would free the so-called rare earth metal exports for the US. Zooming in, Nvidia added nearly 1% as well yesterday on news that TSMC sales surged 40% in May, while energy stocks in the S&P 500 rose 1.80% after US crude tested the major 38.2% Fibonacci retracement on the year-to-date decline and the 100-day moving average to the upside, without, however, being able to hold ground above this critical Fibonacci level into the close. The price of a barrel is hovering around the $65 per barrel this morning, with somehow improved outlook though due to a narrower gap between the supply-demand dynamics. In this context, the EIA's short-term energy outlook released yesterday actually predicts that the US oil production may have peaked and may fall to 13.37 million barrels per day next year. That's a 120,000 barrel decline compared to their May projection. They also see global oil demand rise slower by 800,000 barrels per day instead of 1 million barrel per day predicted earlier, but the demand projections have actually the potential to improve with easing trade tensions if news on that front get better. But of course, the decline in US production is only a part of what OPEC actually brings back to the market. The EIA also projects an inventory buildup of around 800,000 barrels per day, and the world economy is dealing with high trade risks still. Therefore, we may not see oil rally like there is no tomorrow, but the waning drill baby drill policies or drill baby drill outlook could eventually help throw a floor under the year-to-date sell-off in US crude near the $60 to $62 per barrel range. Anyway, we will be watching closely whether oil bulls are ambitious enough to reverse this year-to-date decline in oil prices by sending the price of a barrel sustainably above the major 38.2% Fibonacci retracement level that stands near the $65.35 per barrel mark. Encouraging trade headlines are essential to justify a medium-term bullish reversal in US crude. This being said, while US and European futures are slightly in the negative this morning at the time I am talking here, and that's maybe on some disappointment that not much details were revealed in this US-China plans, except that officials will now take the deal or the plan to their respective presidents and see what they say. Meanwhile, the trade tensions are obviously taking a toll on international agencies' growth projections. After OECD cut its growth projections last week, the World Bank also lowered its own projections yesterday, citing trade tensions and policy uncertainty, of course. So the US-based World Bank cuts its 2025 growth outlook to 2.3% from 2.7% printed in January, and that growth rate would be the slowest in 17 years if we filter out the extreme periods like the global financial crisis and COVID. And besides them, Citigroup is also reportedly preparing to set aside several $100 million more than last quarter to cover potential loan losses. An early indication, according to many, that major US banks could actually be gearing up for a weakening economic outlook for the US as well. Obviously, weaker consumer and business sentiment and potential disruption to global trade routes due to tariffs and restrictions will certainly have a negative impact on activity and growth. Now, funny enough, the levels that we see across equity markets don't necessarily match the growth prospects from the World Bank and the OECD, but it's said that big money managers are actually rather underweight equities these days. Actually, Deutsche Bank, for example, says that their equity positioning, so the equity positioning of big clients, has been lower only 23% of the time since 2010. So it is mostly retail demand that's pushing the equity valuations higher these days, and part of that might be speculation, and explain why on earth the fundamentals and the price action that we see across the global financial markets barely match each other. But even then, equity bulls, retail or not, probably need a solid and a concrete positive narrative to send the major US indices to and potentially above the fresh all-time high levels, because the S&P 500 is now less than 2% below its all-time high level reached in February this year, while Nasdaq 100 needs just 1.30% to print a fresh record high. Small and medium cap companies in the US are recovering as well, though at a slower pace than their big cap peers, as the interest rate cut expectations have been kicked down the road with resilient US jobs data and rising inflation expectations in the US due to tariffs and the trade uncertainties. Now, speaking of that, the United States will publish its latest CPI numbers today, and the latest inflation numbers are expected to show heating price pressures in the US for the month of May. Now, looking at the numbers, monthly core inflation could eventually accelerate to the highest level since the beginning of this year, and that would be bad news obviously for the Fed watchers. If that's the case, the dovish Fed expectations will further ease obviously, so the US 2-year yield will probably extend its advance above the 4% mark, and the latter could tame the positive pressure that we see in equities. A softer than expected set of inflation figures from the US, on the other hand, could fuel the Fed cut expectations, probably not before September though, and somehow support equity valuations. Let's see what the US inflation numbers say, but I don't think that the Fed will be able to cut its rates before September anyhow. Now, in the FX markets, the US dollar is better bid in Asia this morning on the back of encouraging trade news. The euro dollar is trading close to 114 mark, while cable slips below the 135 psychological mark before the UK Chancellor Rachel Reeves announces where she will be spending money. The UK jobs data looks ugly, to say the least, as the British economy apparently lost more than 250,000 jobs since the October budget announcement. The tax rises have obviously taken a toll on employment in the UK, and the price pressures persist due to the budget measures as well, leaving the Bank of England officials in quite a difficult position to act, to say the least. But yesterday's data still tilts the balance in favor of those calling for rate cuts in the UK in anticipation of further economic weakness. As a result, the FTSE 100 flirts with its own all-time high levels, and the fact that the FTSE 100 doesn't have much exposure to the domestic economy hints that the rally in the FTSE 100 could extend, and that despite the gloomy domestic outlook for the UK economy, as long as the global headlines and the Bank of England those remain supportive of the energy and finance heavy index. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.